Bloomberg Audio Studios. Podcasts, radio, news.
I want to get more on this with Kit Darby, president of KitDarby Aviation Consulting on this. Kit, it's so interesting when we hear from officials that the helicopter crew was fairly experienced. Sean Duffy saying the crash was absolutely preventable. What are the questions that you have right now?
Well, thanks for having me. The first thing, of course, the primary charge to pilots on both sides, both aircraft and helicopter, in VFR conditions, which, without clouds you're able to see, is to see and avoid. So in this case, one complicating factor is that the communications to the helicopter and the airplane were on different frequencies. So the situational awareness would go down a little bit, especially for the airliner, not knowing that the tower was talking to this other aircraft. The vision requirements, see and avoid means you can see. We've learned just recently that the helicopter was using night vision goggles. So those are designed to allow the helicopter to operate in very low light situation without any extra illumination. But it also limits the field of vision, and it has a tendency, if you do get a bright light, to bloom or to obscure what you're looking at. So at least one of the pilots in that aircraft, perhaps the one on the side of the airliner, since it came in from the side, could have been using night vision goggles, could have had a vision problem. But even without the night vision goggles, we're looking at a light at night. So it's easy to see the light at night, but it's hard to tell what that light's doing, how fast it's going, where it's going, climbing or descending. So it's a very difficult, against the backdrop of city lights, to know what you're seeing, either with or without vision goggles.
Kit, based upon your experience, how long do you think it will take the NTSB to figure out what happened and be able to communicate that to us?
Well, if the voice recorder and the flight recorder are found and available, and I would expect them to be in good shape, we'll have a lot of information very quickly. The preliminary report should be accurate within a month or so. And then, of course, the full report often takes a year or more. But the preliminary report, with the information we have, video evidence, flight recorders, voice recorders, eyewitness reports, we're going to know what happened here pretty quick.
As we turn towards Reagan reopening at 11 a.m., there have been a lot of questions from the press to officials as, is it safe to fly? What kind of precautions in this kind of scenario would be taken to ensure that?
Well, this is extremely rare, almost random. A reminder that we fly people regularly at 600 miles an hour at 30,000 feet coast to coast, 20 times safer than we drive ourselves to the airport at 60 miles an hour. So, this is a wonderfully safe system, 30 million flights worldwide. Some of our major airlines have 1 million flights, one airline, 1 million flights a year. So there is regrettably a big exposure when we have that much activity. And this particular airport, very congested, all the military services, many of the airlines operating in very close proximity. This would be a likely place for something to happen, but for another accident like this to happen, very, very rare, and certainly shouldn't discourage anybody from getting on an airliner and going where they need to go. The odds are, below a lightning strike.
Right. Kit, I guess what I've learned this morning, I think a lot of our listeners and viewers have learned as well, is a couple of things. One, just how busy the DC airspace was. I just kind of figure if it's not New York, LA, Atlanta, it's okay. But A, it's very, very busy. And B, the mixture of commercial and military, I kind of feel like makes DC airspace a little bit unique. How concerning is it, or what precautions do you think are taken in that airspace for, again, military and commercial to be in such close proximity so often?
Well, there are a lot of rules. I've flown military aircraft in that airspace, although I was flying airplanes, not helicopters, and it was very, very congested. However, there are rules that separate airplane from helicopters, commercial from military, and those rules are followed every day, thousands of times, very successfully. Something didn't work here. The last thing they said was, I have the aircraft in sight, and the question is, how do you hit something you see and have agreed to avoid? I'm not sure the airliner would have had the helicopter in sight, but there's a real quandary here about we know the rules, and the rules were being followed right up to the last minute, and then something broke down. So confusing for me, and I don't know that anybody could make sense of it yet, but soon.
Kit, I think for you and everybody else, also confusing. You've been in this industry for over 30 years. Can you give us some context? You gave great color in terms of what it's like to use night vision, different frequencies. How hard is it or easy is it to move a helicopter going 100 miles per hour?
It's pretty maneuverable. Helicopters do things that airplanes don't do, and that they can hover and go very slow. But when they're flying, cruising, they're very much like an airplane. And both of these aircraft would be very maneuverable. If they saw each other and understood the relationship, speed, distance, what needed to be done, they're both very maneuverable and could have avoided each other with the right visual information. I would equate this to driving at night, how much less you see at night than you do in the daytime. And that's part of the problem here, I believe, is they're knowing what to do with what they see. Helicopter probably had the aircraft in sight. Airplane probably did not have the helicopter in sight.
Very good. Kit, thank you so much for joining us. Kit Darby, president, KitDarby.com Aviation Consulting, giving us some informed views and perspectives on aviation, some of the challenges that might have been before these two aircraft as they unfortunately crashed in Washington, D.C. overnight. We'll have continued reporting on that throughout the day. Let's switch gears and get back to these markets. Again, the S&P is up about 16 points. The Dow's up 68 points. The Nasdaq's up about 17 points. So a slight lift to the market. Sylvia Jablonski joins us. She's the CEO and CIO of Defiance ETFs. Sylvia, we're coming off, two great years in the stock market, 23 and 24, with north of 20% total returns there. And we start off with a nice January in terms of performance here. What are you telling your clients these days about their expectations for 2025?
Yes, good morning. Well, I think 2023 and 2024 are going to be hard to beat, right? They're pretty epic years, but I do think, though, that, we're in a good position here economically. We have 2 to 3% GDP growth. Inflation is kind of coming down, although we've seen some blips. It's arguably coming down and remaining steady at the moment. Jobs numbers are decent. The inflation figures that we've seen recently are pretty decent. Strong consumer. Corporate earnings are going to be interesting this time around, but thus far have been strong the last 8 quarters or so. And so I think that we stay the course here, right? I think the last 2 years have proven to us that maybe it is time to get off of the sidelines. And, when you have like these big dips, like we saw from the DeepSeek debacle the other day, you kind of go in and you dollar cost average, and these are your opportunities to be long equities and get performance. But to answer your question a little bit more specifically, I don't expect a 20% year, but I do expect lower double-digit returns this year.
What do you make of the market action moves on earnings? I mean, without talking specific names, just the drop in UPS, the drop in Microsoft, like Cigna, like it's not taking a lot to get really beat up. Can you put that into perspective for that?
Yeah, I think it almost feels like last season, right? Where good news was a little bit of a drop, neutral news was a really big drop, and anything that was shy of expectations was just like a complete tank, right? I think that the market just has very high expectations for earnings right now that are, somewhat unreasonable, right? I think we got a little bit of kind of like the fire and the tailwinds from AI and kind of this idea that the Fed was going to be cutting rates and things like this. I think, last year was super strong on that. And I think we're kind of steadying out now. And so these earnings, particularly from the Mag 7, they're going to start tapering off. I think we're going to continue to see positive earnings, but maybe it's not going to be, 100% year over year on some of the names. Maybe it's going to be 30% year over year, which is still very solid. I think we just have to reframe our expectations on this.
Sylvia, as CEO and CIO of Defiance ETFs, where are you seeing the flows into your ETF complex these days?
Hands down, it's been in quantum computing. I would say that the 2 most popular trades were MicroStrategy, and that's really a crypto play, right? So you get Bitcoin exposure through that. But quantum computing has just been, an unbelievable story for our firm and for the markets, right? I think it's this idea of it's like the next generation of AI, the fourth industrial revolution. In order for machine learning and AI to actually work, you need supercomputers, and quantum computing has this ability to kind of transform that field, but also just drug discovery, pharmaceuticals, medical research, cryptography, all of these different types of sectors that need essentially an upgrade with technology. And so a lot of those quantum names this year, like IonQ, Rigetti, and I know that they've fallen back like post Jensen Huang a little bit, but I think it's kind of back on the up and up because people realize that this is a technology that's going to bloom and flourish. And we saw about $1 billion of assets come into that space, and it's been out since 2018, and it kind of did nothing, and that's where the flows came this year.
Sylvia, we appreciate you. Thank you so much. Sylvia Jablonski, CEO and CIO of Defiance ETFs. One of the most interesting stock moves I think I've seen is Tesla. That stock is up 1.6%, despite numbers that were not great. And any quality beat was a light quality beat. Like it wasn't a good quarter, yet Elon Musk jawboned that stock up on the call. Steve Mann is Bloomberg Intelligence Global Autos and Industrials Research Analyst, and he joins us now. I don't get it. I do not understand what the takeaway is from Tesla's earnings.
Yeah, I think, the volatility that you're seeing in the stock this morning, I think there's been a lot of noise in the marketplace, a lot of focus on the past. But as you know, the valuation of this company is really driven by AI and robotaxi. And I think, Elon Musk basically backed up the truck and unloaded a lot of positive news about AI and about their future last night. They're rolling out the robotaxi in June. We thought it will be 2 years away, but it's going to happen in June, starting in Austin, Texas, and California, and expanding it to the rest of the a major part of the country into 2026. The other thing that was a surprise was the Optimus humanoid robot. Now, we didn't think that they're going to start production of that robot anytime soon, but the plan is to do that later this year. And one of the things that they're going to use that for is really to help them cut costs in their production plans.
Steve, could you explain the business model for the robotaxi?
Yeah, initially what they want to do is mimic what Waymo is doing. So they're going to produce robotaxis, and they're going to be for hire. The revenues will be generated and will go straight to Tesla. And then down the road, they're going to open up to current Tesla vehicle owners. And the plan is to do it like an Airbnb style, where the owner actually can rent out those vehicles.
When we talk about the quality of any kind of beat, what was circulating in my world was the greenhouse gas emissions credits. And that was a big reason why we saw the beat for Tesla. But that's easy to strip out. Like at some point that goes away, it gets less, we don't need it. So what do you make of that?
They've always been getting credits, so it's not anything new. But what really drove the lower margins in the fourth quarter is really the relaunch of the Model Y Juniper, the update of the Model Y. They're actually clearing out the inventory of the old Model Y. They did that in the fourth quarter. You're gonna see some of that in the first quarter. So first quarter margins will be a little bit bumpy, but they're increasing incentives, better deals on leasing just to clear out that inventory. But what we're hearing so far is, anecdotally, I think on a global level, China and the U.S., there's been a high demand or a high order rate interest in the new Model Y. So we are positive, and we are more bullish on that new product for next year and the year after.
What is the AI play for Tesla stock?
Well, look, if we step back a little bit, they're actually in a transition into a razor blade type of business model, right? I think they've sold a lot of vehicles. They've been cutting costs on building cars so they can sell more and more of these vehicles. But the real revenue and profit generator is the AI, is the robotaxi. It's the full self-driving platform. And we heard it last night from the company. They're going to roll out robotaxi, and it's sooner than I think a lot of people were expecting.
How much of it do you think is the stock movement related to Musk's relationship with President Trump in D.C. versus underlying fundamentals? I realize that might be an unfair question to ask a stock analyst, but just in terms of how you model the relative value.
A lot, because I think it goes hand in hand. Part of this, one of the things that, again, the valuation of the stock is really on AI, is really on pushing out the robotaxi. And now with Musk being closer to the administration, the thinking is that the government's gonna actually deregulate or make it easier for Tesla and their rivals to actually roll out even more robotaxis in the country.
So let's go back to the old car business. Any metrics there that stood out to you about
cars? What?
Actually, yeah, exactly. I hate to answer the question, but I asked the question.
Actually, there is. I think the market is not picking this up, is not fully digesting this piece of news. Is that they actually once they roll out the Model Y, once they roll out the cheaper new cheaper vehicle this year. Hoping to drive higher volume, their fixed cost is going to drop significantly. They just told us last night that using its existing line without new capex, they're going to able to actually produce 33 to 35% more vehicles. So they don't have to use that. They can actually conserve that cash and spend it on AI.
We're just not there yet, basically.
We're not there. I think that when the volume comes up, increases from the new models, then we'll see the benefit of, that rationalization of their line and the reduction of capex.
How close are we to getting that cheaper model that Paul wants to buy?
So far, it's still on schedule for the first half of this year.
First half of this year. Do we believe that timeline? Okay, let me ask a different question.
I mean, we haven't seen it. The thing is, we haven't seen any pictures of it.
Yeah.
And I mean, that's how Tesla's been doing. Like, for example, the launch of the new Model Y, the redesign of Model Y, they really didn't show any pictures of it until really the last minute. And they've been talking about it. They reiterated that last night. So my thinking is that they will.
What's the thinking these days, Steve, in the marketplace among investors, maybe even among Tesla, about the demand curve for EVs? Where kind of are we? Are we in momentum of the demand? What's the thinking out there?
Yeah, there's a big debate. I think we're on the camp of that. If the $7,500 tax credit in the U.S. is eliminated, there's still going to be demand for EVs. I think EVs are here to stay. There's still going to be demand for EVs, but it's going to hurt some of the competitors that are not profitable in making EVs. So it may lead to example like Ford, basically exiting the EV market, and we might see some of the rivals do the same thing. For example, Volkswagen is actually not launching any more new EV vehicles in North America. So if that's the case, there's potential that Tesla could gain more market share.
Now that we've gone through a bunch of earnings for the automakers, GM in particular sort of highlighted the risk of tariffs on Canada and Mexico. Who do you think is best positioned in the car world to weather a tariff storm?
I think for the U.S. automakers, any U.S. automakers that are more vertically integrated in the U.S. will actually benefit. Look, it's going to hurt everybody. Tesla is not immune to it, but it's all relative. I think right now Tesla doesn't build any vehicles in Mexico or in Canada, but the big three do. They do a lot of it in Mexico.
All right, Steve, thanks so much. Appreciate that, Steve, man. Auto analyst, Bloomberg Intelligence, talk about the Tesla earnings. Let's go down to Washington, D.C. The U.S. Senate Select Committee